Good evening, everyone, and thank you for joining us on this call today. We have with us today Mr. Manish Gunwani, Head of Equities at Fund. At this moment, all participants are in listen only mode, and do note this conference is being recorded. Please note mutual fund investments are subject to market risk, so do read all scheme related documents carefully. Over to you, Manish.
Hi, thanks everyone. Thanks for sparing the time. Long weekend evening. So let me just share the presentation with you just one second. Is this visible, Sirishendu? Can you confirm? Is it full screen?
Yeah, Manish, it is
Is it?
full screen and visible. You can go ahead.
Sure. Thanks. Thanks for the patience. Basically, I'll take about 20-30 minutes on the presentation and then we can open the floor. Uh, so the way we've structured this is talk about different time frames. Long term is like 10, 15-year kind of time frame. Medium term is 3, 5, 7-year time frame. And short term is about next 1 or 2 years, whatever we're going to see, the issues which are more near term. Uh, so let's start. I think I'll just rush through the long-term beliefs because a lot of it is what I guess all of us believe in. So when you see equities, while obviously long-term it is the best asset class, Indian households are still, we believe, massively underinvested. In fact, gold at current prices is probably about 240, 250 lakh crores. So the total value of equity holdings of households is less than half of gold, which gives a measure about how much more um, money can come into domestic equity. It doesn't mean that we will have long-term returns in excess of what should happen. It's just that we do feel that these kind of flows essentially make volatility less rather than changing long-term return. I'll come to long-term returns in a bit. But the point is, we will obviously have cycles where domestic flows slow down, then they accelerate. But we do believe structurally that there is a lot of scope for domestic flows to come into equities. Now, coming to long-term returns, I think when we discuss equities, there is a tendency to talk about next 6 months, 1 year, whatever, and look at things like GDP growth or corporate earnings or geopolitical outlook, etc. But I think it's important to remember that on fairly long-term basis, like 10, 20 years, the best way to look at equity returns, and this is true not only of India, but across the world, uh, equities generally tend to return about 5 to 7% above inflation. So if you look at these, this chart is about US and Japan, and it may look like a complicated chart, but essentially, when you look at the horizontal axis, that is time. And the simple point it is showing is that the longer time frame you measure equity returns, they always converge to around 5% real return. That is, inflation plus 5% is the return on equities. The logic here being that typically your fixed income or bonds or bank FD will return about 1 or 2% above inflation. And equities has to be slightly more, otherwise no promoter will issue equity. If the returns are very high, then there'll be too much of equity issuance, which we saw last year, that we had so much a flurry of IPOs because the return on equities had gone up a lot. And therefore, there is a balancing that when the return on equities overshoots this 5-6% of real return, then the promoters issue a lot of equity and therefore return comes down. And when there is undershooting, when the returns are, let's say, same as inflation, then no one issues equity and therefore equity returns go up. So I think this is a very good way to look at what we should expect from equities in the long term. So when you look at India, sorry. Um, Real return of Nifty, that is Nifty 500 versus inflation. Now the graph is back to long-term average or the theoretical average of 6%. And that typically means that we are reasonably well positioned, because if we are fair value in equities, then we should have long-term returns of, let's say, about 10-12% for the large cap index, slightly more for small cap and mid cap from here. Now, does this mean that there is no downside from here? Obviously, no, because as this graph shows, let's say in 2013 to 15 or in between in COVID, we there have been times where equity returns have been below fair value, but typically they are associated with either sharp global crisis which doesn't last long, like a Lehman or COVID, or when the equities reached a fairly extended period of overvaluation, which was 2006 to 10, which is why the next 2-3 years were weaker. We don't, I mean, the second case we don't see. I mean, I think by this chart, last few years have been fairly well behaved. We have reverted around the mean without overshooting or undershooting too much. Global crisis obviously can happen anytime due to some random reason. Can't really build a portfolio for that. But basic point being that we need not be very defensive about equity allocation from here on. Uh, the third point is that I think India is reaching a point where the knowledge-based industries will take off in the economy and also as a percentage of the stock market indices. Um, so one way to think about it is India is a bit like US in 70s. So US, since World War II, a lot of the first 30 years, just like India was India from 1990, was spent in developing the physical ecosystem, which is your roads and telecom and ports and banking, etc., which are more physical capital consuming sectors. But after that, most of the gains in the US stock market have come in knowledge-based sectors like technology, healthcare, industrial products, etc. And you see that Nasdaq, which is a kind of proxy for knowledge-based industries, has outperformed S&P 500. Again, there are cycles, obviously, but when we see long-term, other way to look at it is typically knowledge-based companies have a higher price to book. So the higher price to book companies have outperformed the lower price to book. And when we see, for example, the build out of national highways, the spending on national highways in US as a percentage of GDP, obviously nominal terms, everything will grow. But when you see as a percentage of GDP, that peaked out mid 60s at about 0.5, 0.6%. And today, India, in fact, spends exactly same amount, about 0.5 to 0.6% of GDP on national highways. But clearly, beyond a point, it need not last, because only the finite amount of area will need to be covered with roads. And therefore, we think that from here on, if we take a long-term view, then we need to focus more on brands and technology for growth rather than the more capital-intensive sectors. So yeah, these are three long-term views. Now, medium term is more like 5-10 year kind of views. What we can see in terms of where the world is going from a business cycle perspective. So one we believe is that next decade the growth is going to be less than last few decades. Simple point is actually demographics, and this data obviously cannot change fast enough. So you can be pretty sure that demographics is going to be a challenge. Um, so in this graph, essentially, this shows the birth rates of various countries. Typically, birth rate of 2 is the minimum required for replacing population. So what you will see is that apart from Africa, broadly, there is no region which is blue, which basically means all the GDP heavy regions, the richer countries like US, China, Japan, UK, European countries, they're all facing a situation where population is either peaking out or going to degrow. Um, and if population degrows, it is very difficult for GDP growth to accelerate because obviously if the number of hours worked itself is going down, it's very difficult to grow faster. This is true to a certain extent about India also, because India at a country level is okay, but when you see the more prosperous states, mostly in the south and west, they have birth rates which are like 1.5, similar to Europe. So they will start degrowing in the next 5, 10 years. And therefore, I think India also, we should probably assume 6.5%, and nothing beyond that. Again, there'll be cycles around this, but difficult for India to grow more than 6.5, I would think. The other reason, and which is very topical, which is being discussed a lot nowadays, is basically that protectionism is back, and that is not good for growth. Um, what India saw from, let's say, 1960s to 1990 was protectionism, and we all know that growth rate suffered. So last 3 decades, we've generally seen very good free trade growth, which was very efficient. So every country was doing what they were good at. Now we are seeing that that has peaked out and will start degrowing also, I think, as a percentage of GDP. Um, this obviously again becomes a problem in growth because if countries have to do what they're not good at, then obviously productivity will go down and hence growth will go down. So if overall growth is not going to be great, why should one be excited about equities? We think that Indian equities, along with other Indian assets, will actually have better valuation going forward because of macro stability in general, but particularly I think the Indian currency is seeing once in a generation improvement in fundamentals. So if you go back last 30, 40 years, the usual pattern of Indian currency has been that because we had current account deficit of 2 to 3% of GDP, because we had consumer inflation of 7, 8%, we were depreciating around 4% on an average versus the US dollar and against most other advanced countries. Now, post COVID, we are seeing that India's current account deficit is broadly coming down to zero. Reason being that since remote working has become acceptable, your net services exports, which is software, but also a lot of other services like R&D, consulting, auditing, accounting, etc. We all know that these global captive centers are growing pretty fast in cities like Bangalore, Pune, etc. Though that export is about $200 billion today, which was about $80 billion in 2019. So it's more than doubled. Whereas our biggest import is oil, which given oil prices being on the downside, we are seeing that as a percentage of GDP, our biggest import has fallen and is likely to fall because of EVs and renewables coming in. So when you have a situation where our biggest export hopefully will grow at least 8-10% in the next 5-10 years, and our biggest import is coming down as percentage of GDP. Then we are likely to see what is there on the top chart, that again cycles are there, but if you see our current account deficit is consistently coming down as a trend. And today in FY25, for example, we have reported about 1% current account deficit, but even that to me is a misnomer, because that includes gold imports now, which is about again 1% of GDP. So if you remove gold as because I think gold is more a asset than consumable, and current account supposed to reflect only the consumable part of the economy. Uh, then we can say that we are already a 0% current account deficit country, which is a very big thing, because that has not happened for the last 30, 40 years. And if you see on the other side, US, the numbers are actually pretty bad, right? Your current account of US is 4%, inflation gap with India, which used to be 5% down to 3%. And most importantly, the debt of US has shot up highest since World War II to 120, 130% of GDP. The fiscal deficit, which in normal times was 2, 3%, is now 5, 6%. Um, so the point here is that if that 4% depreciation of currency becomes 1 or 2% for the next decade, every asset in India will trade at a valuation which is higher than the past, because essentially global capital will find it more and more attractive to invest because of this currency dynamics. So, for example, if US 10-year yield is 4.5 and we are 6.5, and if someone believes that depreciation will be less than 2%, then obviously you should be buying Indian 10-year bond rather than the US 10-year bond. So we do think, again, we've seen so much of massive foreign selling, it might look odd to say this, but again, it's not short term. It is what we think will happen over the next 5, 10 years, that we do think the rupee will do much better than the past. It will depreciate somewhere between 0 to 2%. And if that happens, we do think foreign capital in various forms, it could be fixed income, it could be FDI, it could be FII equity, will finally come into India in a big way. So we do think because of that, the P multiple of India for next 10 years will be higher than the P multiple for last 2, 3 decades. Um, so which is why I think the biggest reason to be positive equity is more on the valuation side through this macro stability angle, rather than saying that GDP growth or corporate earnings will be substantially higher. And third is, what is the sweet spot for Indian growth? We think, see, mass manufacturing, I think, is difficult. What Asian countries like Japan, Korea, China have done, because there is a lot of automation, robots, AI, and therefore where we think India will do well is what we call the white collar workforce of India, which is your graduates and postgraduates wherever they're working, because um, there is a shortage of trained people globally. So rather than mass manufacturing, I think India will do well where this white collar workforce, which also is part of this trend of global captive centers doing well, uh, they manufacture medium to high end products and services. So some of the industries which fit this bill is basically engineering, pharma, auto anks, IT product, defense, specialty chem, and also what they consume, the urban affluent consumption, which is real estate, aviation, hotels, MNC pharma. We think that this set of industries will actually lead India's growth. Not every segment of this we may be overweight, because valuation obviously has a role. But in general, we like this theme. Um, we generally don't like the theme of mass consumption, which is FMCG, cement, or um, mass manufacturing. We do think that this set of segments or industries will outperform. Again, these are 5, 10 year views. We may have some other exposure because there is a cycle or valuations are attractive. But long term, we think this is where growth is going to be. Now, coming more to the debates in the next 1 year, which will matter for the market. Um, so one is just looking at data. This is basically what we call the economic surprise index, which is measuring that as this huge amount of data keeps coming out of economies. It could be car sales, PMI, IIP, whatever. Uh, so this measures how much of the data is beating expectations. It is not absolute. So a country with 1% GDP may have a very high rating because the data is better than what was expected. So what it shows is that when Trump came in, the US economy was on a high, and along with Trump, the economy doing well, everyone was bullish on US. But if you see since December, the economic data of US has been surprising on the negative side, which is why that blue line has fallen. And what has taken markets by surprise also is that Europe and China, which is emerging market, which have been dogs for many years, there the data is much better. If you see India, the economic activity indicator again built from these high frequency data which comes out seems to suggest that the GDP growth has bottomed out. May not be a strong rebound, but a lot of indicators are quite positive now. So overall, if we look at three big issues, I think the biggest noise around tariffs. And while there are a lot of specific things we can talk about, but essentially, our feeling is that US will have to sober down a bit, and um, the intensity with which they've been doing these policies will come down. The tariff rates will also come down to a mind. The logic being that, first of all, in a democracy, when there is too much pain, I think the policymakers have to correct it. So we clearly are seeing US economy slowing down. And also, I think the biggest negative surprise for US policymakers is how the dollar has collapsed. Because when you put tariff, let's say you put 20% tariff on an exporter, I think the logic the US policymakers had was, dollar will go up, let's say 10%, and therefore that 20% will not hurt consumers and businesses within US. Now, clearly that doesn't seem to have happened. The dollar has actually fallen. Particularly yuan has been quite stable. So the point is now the US consumers and businesses are actually facing pain because the dollar has not acted as an insulator. Therefore, we think at this point we are more likely to see um, more reconciliatory measures from US apart from China, because I think China they see more as a military rival, so difficult to predict. But for India, actually, it might turn out to be a good thing if the tariff differential between China and India is very high. So right now, so it is crazy at 145% versus zero, but obviously the zero will not last. Um, So I do think that we've seen the worst of the tariff news. More likely, and this is probabilistic, obviously, no one can be sure. More likely that we will see uh, US go a bit soft on this, try to do bilateral deals with Europe, Japan, Australia, India, which are fairly having decent relationship, and hopefully the US economy kind of will slow down, but not go into a deep recession. So that is how we're thinking around this tariff. So the key risk here is probably the big single most important thing to track is the yuan. If yuan depreciate 5-10%, I think that is when downside for the market will be there, because if yuan depreciates 10%, every other currency will also depreciate and US dollar will appreciate, and that usually will lead to big market fall. But if we see that the yuan is stable, then I think we should see things improve. The second important trend, which has got lost in this tariff news, is a big stimulus by Europe. So Germany has announced $1 trillion stimulus over 10 years. Most European countries will spend more on infrastructure and defense surely, because US is now uh, pulling out of Europe's defense. And if the Ukraine war slows down or stops, then there'll be a lot of spending in Ukraine as well. So uh, Europe as a region can surprise, we think, on the positive side, because expectations are also very low. So that is one other important trend we have to monitor. And the Indian side, I think a lot of good things have happened. Again, in this tariff news, probably not paid enough attention to. One is that the monetary policy is very pro-growth. So if you see RBI, not only in terms of cutting rates and adding to liquidity, but when you see how they're behaving with lenders, the lot of focus on tempering growth is now gone. So things like LCR, LDR, which they were very stringent about, a lot of specific banks or NBFCs which had some regulatory action, all those are being reversed. Um, and second is the exchange rate now is very competitive, because while dollar has fallen 9%, we have not appreciated that much. So against a lot of currencies now, the Indian rupee is looking very competitive. Fiscal spending is still weak. Ideally, we should have seen fiscal deficit not so much in contractionary mode, and we should see better government spending. But anyway, two out of three stimulus are there. So we do think that, as I said, the Indian policy is now much more pro-growth than last year. In terms of valuation, as I said, long term, the inflation plus 6% rule suggests we are at fair value. P multiple actually is attractive, also because, as I said, we believe P multiples will be a bit higher than the past. Some of the other things, like when you see earning yield versus bond yield, when you see currencies valuation, when you see P multiple of India compared to emerging market P multiple, they are all again more on the medium side, fair value side. The only thing which is a bit cautionary is the global credit spread and global volatility, which usually go up when a global crisis like Lehman or COVID happens. They are very, very low. So from a contrarian perspective, this is definitely not distress valuation. Uh, but sometimes these things can take a lot of years to spike up. So you can do limited amount of timing on all this. But yes, definitely from that perspective, it is not a big bottom right now. So from liquidity, again, I think good things are happening. The biggest is, of course, the dollar. This was about 2 weeks back. Now the correction is now almost 10%. US bond yields actually fell, but they're now back a bit. Um, Crude is down, which is again a very big positive. Only other thing is that China post DeepSeek seems to have attracted a lot of flows. Usually, before that, most of the emerging market flows were avoiding China, which has a big weight. But I do think that if dollar is weak, then India will start seeing positive flows at some point. On the domestic side, rates obviously headed down. I think the balance sheet of households has improved a lot because of gold. So roughly in 1 year, $500 billion or about 40, 50 lakh crores is the value of appreciation of household ownership of gold. I know people don't see at gold as a very liquid asset, but still it is a big amount. For equities, I think one challenge will be 1 year return for many schemes will become negative at some point, which typically, historically, we've seen flows slow down when that happens. But again, I think given the maturity of the Indian equity investors, hopefully we will not see too much of a slowdown. And also the good part is because of SEBI measures last year, the retail activity is fairly subdued, which again, from a contrarian perspective, that's good to see that the F&O activity is very low at this point of time. So just to summarize what we are saying, one is that long-term indicators along with improving macro makes us incrementally more positive. We think distributors and investors should add risk at the margin. It is not a big bottom, it is not distress valuation, but what we are saying is if you were staggering over 6 months, you should stagger over 3 months. If you were staggering over 3 months, maybe you should do lump sum. So I think the direction has to be to add more risk. We do see a lot of positives which are getting clouded by this tariff discussion. Um, of course, if US goes into a sharp recession, we will have a bit of downside. But usually US recession don't last for more than 6 to 9 months. So even if that happens and if you're patient, then I think decent returns can be made from here. We in fact, for investors who can digest volatility and look at 4, 5 years. So with that, I'll stop.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.